I'm going to start right in with, jumping right into this question. What advice? Like, it's, how bad is it? I don't think there's any single one of us that goes on our social media wall every day and we hear about just how bad it is out there. And what advice would you give to anybody who wants to raise in today's market? And I don't know, maybe you have a perspective, whether it's a good or bad market, on how to get investors' attention, because it just seems like everything says it's like a bad time to raise. Kevin, why don't you start us off with this?
Sure, I'm happy to do that. And just by way of background, I come from the emerging technology world, specifically a crypto, metaverse, and Web3. So yeah, I'm dealing with companies in a space that are highly cyclical. There's a lot of volatility. I think that, yeah, I don't think it's good advice at all to say that that companies or funds like mine should not raise money because current sentiment is negative, particularly as a company right now, right? Because these markets are cyclical. I think if you look at the space where I'm in, these bull and bear markets, typically they evolve in 4 to 5 year cycles, and typically the best companies that really take off when sentiment finally does turn were generally, as a rule, in the last 10 to 15 years, started in the depths of a bear market. So there's still a lot of capital in my space that needs to find a home right now, needs to find a productive use. I think that it's just as good a time, if not better now, than it would have been a year ago to raise money. I think the second part of your question, Sally Ann, was what to do to distinguish yourself from other companies or other projects that might be raising. I think it's pretty straightforward, really. I mean, I think and I apologize, I'm coming at this from from the lens of technology, and some people here might be in a different space, but I think the days of investors just throwing money at companies that were just seeking growth at all costs and didn't really have a sustainable way to find a path to profitability, I think those days are probably over. I think, realistically, I mean, if a company has that path to profitability and they've shown that they're on a trajectory to be profitable in the next, say, 1, 2 to 3 years, I think it's still a great time to raise.
Wow, I like that. What about you, Sharina? How do you feel? What advice would you give anyone wanting to raise, and how to get investors' attention? Coming from, I think you're in the real estate sector primarily.
Well, no, since your target audience is, a lot of founders, Sally, if you don't mind, I'll just throw my hat in that respect.
Sure.
To answer the question. So, and my answer is going to be a little bit more specific. So I would say, first of all, your first part of the question is, what advice do you have for anyone wanting to raise funds? I think it's a mindset. So to answer that question is, yeah, you don't want to raise funds, you want to grow your business. So that's...
We can't hear you. You're breaking up.
Can you hear me now?
Not clearly. There's a lot of echo.
I'm so sorry. Is that better?
No.
No. Okay. Should I sign on and come back in?
Yeah, why don't you try that? And let's have Stephen grab the question. Okay. Are you using earphones, maybe?
Yeah, maybe I take them off.
Yeah, take the earphones off and just use speak without the earphones. Maybe try that.
Can you hear me now?
Yes.
I don't hear you. Okay, I'm going to speak because I'm not hearing you. My advice was going to be very specific, targeted to founders. The first part of your question is, what advice do you have for anyone wanting to raise funds today? And I was just about, my answer was, as a mindset, yes, you would want to raise funds if you want to continue to grow your business. The second thing is how to get investors' attention. So my specific advice on that is, one, look at your current investors. You want to address how your business model is.
We lost you again. We lost you again. No.
Whether it be inflation or rising interest rates. I think, have the specifics how your business model is going to treat with a rigorous, environment over the next 18 to 24 months, which is really the outlook we're having within possible downturn. And then if you want to look at new investors, it has to be very, very targeted. Look at investors who would look at your sector. So for instance, Kevin spoke about startups that succeed in downturns. So for instance, digital interface in COVID, was very successful. Credit Karma, for instance.
We're losing you, Sharina. We're losing you. Hold on. Let's see if I can.
There's opportunities depending on the downturn sector. So depending on your industry, there's an opportunity in that current economic environment. It's a great opportunity to go to new LPs. So, I sort of answered it in a very specific manner. So I'm going to switch back onto my headphones to hear you.
Yeah, please do.
Yeah,
please do, Sharina. Sharina, we kept losing you on and off. So maybe if you can log in and log back out without the headphones, maybe turn it off. That might be really helpful, just so the audience has the benefit of your wisdom, right? Because you have yummy stuff to share with us. All right, Stephen, let's hear what your thoughts are on this.
Wow. So thank you, Sally Ann. A lot of my comments are the same, whether it's a bull market or a bear market, because the fundamentals are the same. I love the people who talk about raising capital in a bear market saying, oh, well, conserve cash flow, obvious. Figure out how to make money, obvious. For me, it's a lot of the same principles, but I deal a lot with startups. So I'm always almost in that startup early capital initial fundraising. And it's the same. I think Sharina said something. Number one, capital follows customers. The three simple words I tell all the entrepreneurs, all you need to know about raising money is three words. And it's not how do you make money or who's your investor. It's capital follows customers. Every time we've ever raised money, the first question or one of the first one is, who's your customer? And so focusing on that early on, even if it's a letter of intent or somebody who says, yeah, if you build this, we would be interested. Getting that customer adoption early is number one. Two, I have about 5 of them, but I'll do another one. I've won 8 contests around the world in blockchain and crypto, and I've won more contests than any company on the planet. So I've done this for a long time. Entrepreneurs, we oversell the opportunity and the concept without overselling the exit of how they make money. And even if you're early stage, if you're mid stage, if you're growth stage, focusing on that, how do you make money and how does the investor make money is one of the most important things. And I've watched the startups make this mistake. I've been in rooms with guys raising $1 billion and their focus is very tight on here's how we make money, here's how you make money. So even in a downturn, talking about conserving cash and cutting back, that's great. It's laser focus. Here's how we make money, even in a downturn, and here's how you will make money when we're successful. Okay. And I think those are two of the primary ones that are timeless regardless of the cycle.
Thank you for that, Stephen. I'm going to go back to you, Kevin. Sorry, Sharina.
Can you hear me now? Sorry, I just wanted to.
Yeah, yes, we can hear you, but right now. Are you fundraising right now, Kevin? And share with us, and what are you fundraising for? And, this is really an opportunity. As I said to you, everybody watches these talk shows. Share your challenges so far, and how are you addressing them?
Yeah, of course. I think, the answer is yes. I'm raising right now. So I was an entrepreneur in the past. I made the switch over to work with a venture fund a little over a year ago. And we're raising $100 million right now to invest in Web3 and metaverse startups. So we're not crypto exclusive, but we like to say we're crypto friendly. And we do look at companies in the space. So yeah, I think we've been at it now. It always takes a little while to get all of the regulatory pieces in place on the board and then start raising. We just really started in earnest at the beginning of the year. We're 20% of the way to where we want to be, to our target goal. I do believe that we're going to get there. Hopefully by the end of Q2. I guess we'll see how it goes, but all indications are that we're having some early success. What are the challenges that we face? Look, I mean, I think raising money should be hard, right? If it wasn't hard, then none of us would be as disciplined as we have to be. And I think that is particularly the case in a bear market. At the same time, I think one of the advantages that we face is that we're raising capital globally, right? Like a lot of venture funds, a lot of startups in our ecosystem, they generally tend to focus in a specific geographic region. Maybe they're based in Singapore, maybe they're based in San Francisco. But we very intentionally brought in partners through a global network, and we're all really rowing in the same direction. So even though market sentiment might not be as high in Silicon Valley as it was a year ago, in Riyadh and in Tokyo, they're as bullish as ever, it seems, and they have a lot of capital to put to work. So I think that's a great strategy, that could mitigate the short-term impacts of the cyclicality in this market. Is just cast a wide as net as you possibly can, given your network, and given that everybody on this call is talking to people like Sally Ann. I'm sure that you are probably already doing that. So I think that's a great strategy to mitigate these short-term negative emotions that plague investors around the world.
I want to add to that, since you mentioned you're raising abroad. What's different in your due diligence? Because you're looking for investors to come in. What's different in the DD and how you raise geographically abroad? Because it applies even for startups, right? I was a startup in the Middle East and I raised in the US, right? Very different from raising here in the region. You're in the US and you're raising, out in, Saudi and other places. So how does the DD look like, and how do you screen, and how do you, share some stuff with us on that?
Yeah, no, it's a very good point. No, I think there are definitely a very different list of considerations if you're raising money as a U.S. entity than if you're raising it, if you're basing in, say, in the Emirates or in Asia, and that's totally fine. I think I would say that it's we're subject to a more stringent standard, particularly with regard to regulatory KYC and AML here in the States, and that's okay. I think that's as it should be. That just ensures that there's a bit more work on the front end, but that means that it's much more likely that we will not encounter any problems down the road. I think one of our investors who we're currently working with once told me that it's better to, like, some people like to sleep well, some like to eat well, but people are rarely able to do both. I think, if you take some pain on the front end to go through that exhaustive KYC and AML, then you're definitely going to sleep better down the road.
Okay. Sharina, what about you? Are you fundraising right now in the real estate sector? So I want you to talk about that, because we do have a lot of people that are not startups within the sector. For what? And share your challenges so far and how are you addressing them?
Yes, we are fundraising for two funds. Primarily, I'm focused on a hospitality fund. The size of the fund is 450 million, and fortunately, we're almost halfway there. So I think that helps quite a bit with LPs. I focus a lot on institutional LPs. So one of the challenges in the current environment with the downturn in the public equities market, what has happened is the value of their public equities has lowered, and the exposure on the private equity side is then, simultaneously increased. So you have that sort of overexposure to private equity asset class. So that's one of the main challenges. What we did is we developed a strategy to go back to our current LPs and offered a sort of participation that is a little bit shorter term, because the fund is 10 years. So that in a way sort of blends their risk exposure to the portfolio. So I think it's really in coming up with creative ways, how to offer, the participation to the respective LPs. Another challenge in real estate specifically is that the cost of debt, you know, we've had almost 7 increase in rates, you know, over the last 18 months. And when this fund was established December 2020, so it was in an environment where it was very difficult to get fixed rate in earlier days. So we've had the acquisitions on the floating rate. And with these, you know, several incremental increases, we had to be sort of creative in trying to look for an alternative source of debt to sort of, you know, take out some of the floating rate. And we've been successful in very advanced discussion with something called PACE financing. I don't know if Kevin is familiar with it. And PACE financing is it takes into consideration green, you know, the green funding, you know, so that your acquisition can qualify for it. And because it's government backed, the rates are much, you know, it's much lower than the current environment. So those are 2 ways that we sought to mitigate. You know, when you know, one, looking at the current LPs, looking at a customized product, and also looking at our cost of debt when we approach the LPs actually to talk about the performance. What you missed in my earlier discussion, how to deal, you know, with challenges in this environment. I spoke about looking at your efficiency. So when you're fundraising, you would want to, for each of your respective business, you would want to highlight to LPs and prospective LPs what you are doing to prepare yourself for the next 18 to 24 months in the outlook. And that's very important. You can highlight, you know, it shows that you're proactive. It shows that you can still continue to add value in your business, you know, throughout this month.
Okay, thank you. Very, very helpful. And yeah, Kevin, you know, you and Sharina might have lots to talk about.
Yeah, it sounds like it. Thank you.
Stephen, from a startup, I know you've had many startups. So are you fundraising now for what? And I know you've had, you know, a history of so many challenges, and I'm sure in that you've had many no's and many, you know, yeses. You know, share what those challenges. You know, I can certainly share as a startup founder. If I had to count every no, I think I get like 20 no's for a yes. You know, when I started off not knowing, right? But share with your experience.
Yeah, we have different things at different levels. We have 2 that are coming on market at 5 million each, one for what are called NFBs, which are non-fungible books, trying to disrupt its $148 billion book market, moving books to a smart contract for publishing. And then I'm going to retrofit the art world where the author's going to be able to have limited edition numbered books, signed and numbered, or they'll come with access to, like Deepak's going to do something where you get a 30-minute Zoom with Deepak Chopra. So I'm taking a, you know, $19 digital book asset in Web 2.0 and moving the value up by repurposing the same asset. So we're preloading the authors. The platform's already done. So when we go to funding, we'll have that lined up. And then we're also doing NFC for non-fungible couture, $3 trillion market of fashion. So we've got a fashion marketplace, part Etsy, part OpenSeas. So those are 2 early ones, but again, we're preloading.
Okay, so you're fundraising for those. Share the challenges. Have you gone out to investors yet? And how are you addressing them?
So that one's yes, we have, but I'm also trying to play the game. So the non-fungible couture, for instance, is a fashion site. And unfortunately, I live in LA and Dubai. I'm in Dubai right now, and then, you know, Abu Dhabi and Riyadh. I'm playing people against each other for the narcissistic ego. Same thing I do with venture guys. So in the fashion one, I have Muhammad Hadid, which his daughter is Bella Hadid, very famous. And then I also know Kris Jenner because I helped her years ago start the whole Kindle makeup line.
Yeah.
So
but Stephen, I want you to focus on the challenges so far and
the
how
challenges is getting
them.
somebody to say yes first.
Okay.
So you need to get somebody to say yes first. And the easiest way to get somebody to say yes first is to play to their ego, to think they're going to miss out if they don't do it.
Okay.
I already have the next people in line.
Okay.
So same thing on the book publishing. I went to UTA first and said, you're my first call because I like you. You're best here. If not, my second call is IPG. My third call is CAA. So the challenge is always getting that one to be first.
Okay, so the fear of
And-
missing out, FOMO.
The fear of missing out. People do more to avoid pain than gain pleasure.
Yeah.
And so the pain of missing out, but the only way to play that is to know your cards of who you're going to next. So they
Okay.
don't want to miss out on that. Oh, if I don't take it, he's going to take it somewhere else.
Okay.
But the challenge is always there. We've got a $50 million green bond that just closed. I think the paperwork's done. So we're threading the needle on equity instead of doing equity. We wrapped it into a green bond because the green bond funding is there.
Mhm.
But again, these were challenging because we had to convince the banks that our intellectual property was worth $50 million when it was very nascent. But the
Mhm.
bond guys are much more interested because they get a predictive rate of return.
Mhm.
So again, the hardest part of capital is getting the first customer or the first big dollar in, and the easiest way to do it is fear of missing out.
Okay. And that's a very legit for most startup. Hold on, anyone who's gone to startup founding accelerator school, they teach you, right? Like, definitely you want to be, if you don't come in now, you're going to miss out. I appreciate that. I'm
Could I,
gonna
uh,
go-
could I
Sure,
chime
kick
in
in.
just with one quick follow-up? So yeah, just having been a founder in the past, I generally, particularly if you're at a raise from venture investors, which, I don't necessarily think that's the best move when you're in the pre-seed or seed stage. It's always better to find like an angel or two in
Sure.
your industry first. But if you are raising from venture, I mean, the best thing you could do is to network and meet as many of the like the tier one and even tier two venture investors as you can. Like nothing works better than a warm introduction to get into like their real pipeline. And yeah, the best way to do that is just get out and meet as many of the venture GPs and honestly the founders as you can, because venture GPs take recommendations from other founders that they've invested in and particularly had success with. They take those referrals very seriously. So that's a great way to get a leg up on all the other founders out there who are raising capital alongside you.
Yeah, and I agree with you on that, Kevin. I mean, before I raised in the US, from the UAE, I used to travel to the US and go to ASU GSV, which was like kind of like the largest meetup in my particular space, and just created relationships. So
Right.
by the time I got ready to raise, they already knew what I was doing, who I was. They had seen and the first call for my first seed was actually the venture fund calling me going, "Are you raising, by the way? We're just creating a fund and we thought of Gleek." And I just thought to myself, like, how lovely is that, right? Because it was 2 years of building relationships. So you're absolutely correct. For every relationships are critical, and those warm introductions. And I love that you said you get into the real pipeline, because there are two pipelines and people don't realize that, right? There is the I have a network interconnected with this person pipeline somehow, whether it's through founders, whether it's through warm, and there is the cold call pipeline.
Right.
So I love that you mentioned that. I'm going to ask you this question, Kevin. Since you are in this space, how has the recent revelation of fraud in the crypto market impacted fundraising as a whole? I mean, even for you, right? Like coming out in the Middle East and fundraising with all of this stuff, like has it impacted at all or not?
So it definitely, it's a question that we get at every meeting, right? Like, oh, did you lose any money with FTX? The answer is no. But I think it's definitely on everybody's mind, and it of course it's going to be, right. It's been page one news on certainly on CNBC here in the States and in the in mass media for quite some time now. It's actually a fascinating story. So has it impacted our ability to fundraise? Not really. And here's why. I think that, and I've realized this after working at crypto for almost a decade, is that it's really not my job to convince investors whether that they should invest into crypto assets or cryptocurrency. They need to take that journey by themselves, right? I mean, I'm not. It's such a polarizing topic. It's not just financial. It can often be philosophical for people. Like do we want to like allocate to this crazy new like magic internet money that governments don't control? I mean, Some people are okay with it. That number seems to be increasing every year, but not everybody is. But our job really is, once somebody arrives at that conclusion that, hey, this is something that we need to get our family office, our institution, or my own money into, then that's what it's my job to convince them that we're the team, or that my project is the one that they should work with out of all the others out there in the field.
What
So
about
no,
you? No,
that's
so
right.
you, Kevin,
That's
go
it.
ahead, please, go ahead.
No, that's it. That's a very long-winded answer to your question. I don't think it's impacted the ability to raise, because there are enough people now who understand that, I think particularly in the crypto space, the industry is continuing to grow. Smart people are continuing to build. Like I said, OpenSea, which was probably the biggest success story in the venture market in crypto in the last cycle, was built in, it was founded in 2018 in the absolute depths of the bear market. Coinbase was built in the absolute depths of the 2012 bear market for crypto. So yeah, it's not an issue for people who have been paying attention for a while.
And what about you, Sharina? Has it impacted anything to do in your sector at all, or no?
Well, my perspective is a little bit unusual. So I think one of the questions you and I floated with each other, and I think amongst the group, is have you done any fundraising outside of your geography? So our firm is based in Miami. It's one of the private equity, very unusual 20-year-old private equity firm in Miami. We have lots of private equity firm now moving into Miami. But I had developed a strategy for the firm in the Caribbean. And I've been very successful with it. In, the English-speaking Caribbean, Trinidad and Jamaica specifically, and Bahamas was an island I had targeted next. However, with the FTX collapse and when Bankman Fried based there, I'm practically going to stay away from Bahamas just because of that, because I'm just not sure of the investor confidence of even going to that island right now. So it is just, so in my perspective, it's quite different, but in that regard, that's how it's affected me in my fundraising. I've had to actually go away and not look at Bahamas, not look to spend time with,
We lost you again, Sharina. Yeah.
I did test Talia. I tested my microphone.
Oh, it's okay. Yeah.
Now?
All right. Yeah, we can hear you now. Okay, Stephen, what about you? Any impact on you in the startup?
This is a weird one because I fight this fight. There's no such thing as cryptocurrency. They're glorified penny stocks. There's no such thing as a blockchain company. If anybody tells me they're a blockchain company, even us, we're a blockchain company. We're not. Somebody says they're a blockchain company. I'm like, what do? They're a game company. They're fintech. So the segmentation's eventually going to change back where nobody will be a blockchain company any more than they're an internet company. So the conflation is really difficult. I deal with Bermuda. I help write the laws in Bermuda and Malta. I'm in Dubai now. I'm in Riyadh tomorrow. It's tough because even with FTX, I was at dinner with a bunch of people. And I wrote this in the chat. Comparing FTX to crypto is like comparing Bernie Madoff in the stock market.
Yeah, but
what Sam did had nothing to do with crypto. If people will figure out, it was pure fraud.
Yeah. So Stephen, my question though, because you have to remember I have an audience looking for specific.
Yes, I apologize.
To questions. So how has the recent revelation of fraud impacting, or has it impacted your fundraising as a whole?
Well, to me, it's going to help because I think the industry needed to be wiped out and cleaned out of most of the fraudulent activity and a lot of the projects that had absolutely no business ever getting funded. So what should come out of what I call crypto 3.0 will be more projects around legitimate companies, existing companies using digital assets to raise capital, not startup projects that were basically crowdfunding using tokens with no substance.
Okay.
So in the long run, it'll help.
Okay. All right. And that's, and I think I'm of that feeling, or a lot of people I know are of that feeling that, it needed to happen so that the projects with real substance can now bubble up. right?
This is no different than the tech collapse of 2000, which most of the people aren't old enough to remember. It wiped out all the paper napkin startups.
Mhm.
And then the legitimate projects came through and survived. The companies that come through in a downturn, every economic downturn, and the bear market of crypto is going to be no different. The legitimate projects will survive, and the easy money speculators hopefully will get shifted out. And
Okay,
this will do nothing but help the industry moving forward.
okay. I'm gonna go to Sharina on this one. What mistake do many entrepreneurs make or leave out in their fundraising presentations? Particularly, let's say in a downturn market. What would be critical right now that, you know?
Yeah. So I think I answered some of it in my
Yeah, you
earlier
did. And that's why I'm going back.
speech. So I think first thing for one of the firms that are fundraising, especially if it's early fundraising, is look for the opportunity in the current environment. So I made an example of Credit Karma in 2008, when there was a collapse, and it was really based on bad credits, on bad mortgages. So Credit Karma came up with this scoring system that masses can have access to, and they have been extremely successful in that environment. We have the last mile delivery firms that take advantage of the COVID. So I think that you are asking specifically the mistakes.
Yeah, mistakes they make and the things that they leave out that they shouldn't be leaving out in their funding, request presentations. That's really critical right now.
Yeah, what I find especially in early funding, like seed funding, a lot of times they talk about how they're different, what multiples, what returns, etc. But they don't specifically show your capital, what is going to happen in the 3 stages thereafter. Sometimes I see that missing in some of their decks. They would talk about what the firm is going to do, but they would then say, I'm raising 100,000 or 300,000 or a million or what have you. But they don't give a full example of how the value, what is, if it's going to create a multiple, how it's going to get to that multiple of 10 times. You know what I mean? Like, I always have to go back and say, well, what do you mean by this? What do you mean by that? So I think it's sometimes a little bit too airy-fairy out there as to how the multiples will happen. Because just one thing I want to leave is that family offices, and that's another set of investors by themselves, they're unique by themselves. For instance, they don't want to go into a fund. They want to be co-invested in a real estate instance, right? They would look at startups in the VC space for the multiples, right? They would think in a real estate asset class, they would have maybe 2 times, 2.5 times, possibly 3 times. But when they look at a startup, they're looking at 5 times and 10 times. And sometimes that the actual pathway to that is where I find sometimes they're missing.
Okay, I like that. Pathway to the multiples. What about you, Kevin? What mistakes? I mean, I'm sure you're seeing tons of startups applying to the fund. What is it that's missing in these presentations that you're seeing that you wish you saw more of?
I mean, we're really fortunate right now in that we're seeing some truly exceptional companies coming through the pipeline. If anything, I suppose what we're seeing right now are unrealistic expectations with regard to valuation. And I realize I may be contradicting myself, my earlier statement just a bit. I think that it's a great time to be raising money. That being said, I don't think it's a great time to be raising money with the same valuations that companies may have had in spring of 2021, a year ago. So I think that there's probably an expectations gap with a lot of the companies we're seeing. That's okay. It's just, it's for the really good companies, the ones or the projects that we really believe in. That just means it's a longer negotiation, right? Maybe it works, maybe it doesn't, but it definitely does make it easier to end the conversation with those companies that may not be, squarely within our within the sweet spot of where we want to allocate.
Okay, cool. Stephen, real quick from you.
So I think that
Kevin, you're breaking up also. I don't know what's going on today. Kevin, are you? Yeah, you're breaking.
Yeah, I can hear you loud and clear. That's
okay, cool. Yeah,
that's
sorry. You want to, is there anything else you want to add on there?
No, that's it.
Cool. Stephen, what about you? What is it that most entrepreneurs leave out of their funding presentations?
How the investor's going to make money. You know, they focus on selling the idea and the concept, and then they go into team. And at the end of the day, the investor's sitting there thinking, how am I going to get out of this? So what's your exit strategy? What's your multiple? Who's your potential strategic buyers? It's almost always missing. We have a slide that's called the arc of exit. We have a little rainbow that says, here's who we think we would get acquired by from most likely to least likely. And we're able to go through, you know, the companies in a multitude to give the investor a clear path of where they could potentially get out.
Kevin, how do you feel about that? A clear path to exit in looking at.
Yeah, I think that's always been important, not just in the past year, right? I mean, anybody who invests in certainly an early stage startup wants to understand, you know, whether it's a strategic or a financial buyer that will most likely provide liquidity, right? After, you know, like, you know, most funds like ours are looking at a 5-year horizon, right? We want to have a reasonable expectation that there's going to be an acquisition or some other sort of way for us to get our money back within 5 years. I don't think that's ever changed.
Okay. I'm going to ask Sharina this question. I have Govinda coming in. Sharina, have you ever taken the money? You know, a lot of the startups, you know, we keep reading about a lot about this, about their valuations just being through the roof and, you know, valuations getting adjusted. What kind of advice, and have you ever been in that situation where the valuation, whether it is of your company, whether it is of your fund, whether it's of your real estate, you know, within that, someone has a baby? Can you put mute on? Thank you. What? Okay, hold on. Let me see who that is. We have a lovely, lovely little baby on there, but we need to, can we mute whoever that is? Thanks so much, guys. Sharina, what would be your advice to a startup founder, or even, you know, whether you have a situation you have to share where you took the money at a lower valuation, but it technically has impact, right, on your previous investors? What are the considerations for taking that kind of money?
There is a specific example, I would not share the name of the firm, where they've taken an investor.
Sharina's breaking up again. Are you guys hearing her, or no? She's breaking up for you also.
Yeah, she's breaking up.
Yeah, she's breaking up. Okay, let's try, Sharina, we'll come back to you. Let's try Stephen on this.
On which question again?
Valuation. Do you take the money at a lesser valuation, or do you hold on to your valuation for your previous investors?
We've never had to do a down round, so I don't know how to answer that. When markets were getting tight, we became more capital efficient. And if we had to take on additional capital, a few times we did bridge loans into the next round at a discount with some of our prior investors who believe. But yeah, we've been fortunate. I've never been desperate enough to have to do a down round.
Okay, but you explained how you got around it, right? Got creative around it, you know, doing bridge. Yeah,
going back to a bridge with some of our prior and current investors who liked it and making them a better deal on a convertible note and discount was a structurally more advantageous way than to try to down round and then you upset all of the people who believed in you early on.
Yeah.
And I don't like the people that come in early are the ones who need to be protected the most, because by the time you get to BCD round, they're the ones that are protected the least.
Okay. And what about you, Kevin? What's your thoughts on this? I know you've raised money for a lot of startups yourself.
Yeah, I have not had to do a down round either. Thankfully, there's definitely a stigma that comes with that. And if you're a founder, you know, depending on the terms that you have already struck with your existing investors, you know, raising a down round can be catastrophic, right? Because a lot of, particularly if you're raising money from venture investors, they usually have some sort of liquidation preference built into the terms, which means that if you raise money in a down round, you know, you need to make them whole at that lower valuation before you could take any of that money off the table, which means that you could potentially be diluted substantially. So I think the best the best mitigating strategy here is just to be very conservative, very realistic about the valuation you're raising money at right now. You know, there were so many companies, particularly crypto, that raised, you know, just off of a PowerPoint presentation, you know, we're able to convince investors to raise money at, you know, at 9-digit valuations. And I hope that they're being very judicious with how they're spending that money, because they're going to have to spend a lot of time growing into it and avoid being diluted in the future.
Okay, Sharina, let's try again.
Can you hear me better?
No. Can you, it's the microphone. It's the microphone. If you turn off the microphone and you just talk on the computer, is that possible?
Oh,
No.
I get it to the computer. Maybe I'll-
Yeah, it's okay. It's okay. It's okay. All right, let's ask, and maybe you can type it in, Sharina. Why don't you type in your story? Yes, Stephen?
If I can, Sally, I want to share a strategy. It's not meant to be overly complicated, but raising capital, especially early stage, if you're an early stage founder, if you raise too little, you know, if you go, oh, I'm only trying to raise 150 or 2 or 250 or 500,000. If you raise too little, angels a lot of times don't want to give you money because they're afraid you're going to run out. If you try and raise too much, then your valuation gets you diluted and you're like, oh, I don't want to raise 5 million because, you know, if I put my valuation at 7 or 8 million, I give away too much capital. And we do something a little creative. Like on our startups, we'll always raise 3 to 5 million on a valuation that's in line, but we usually will only raise $1 million or $1.5 million, and then we close the round. And then we use that capital, hit milestones, and then go back. So
Okay.
we're saying we're raising more on a valuation, but we're not going to raise all of it at that dilution point. If our number was $1.5 million to $1.8 million, we don't raise that. We try and raise 3 to 5, but we don't bring all the capital in on the dilution.
Okay. All right. Maybe you need to mute one of them. Yeah. Sharina. Okay, now let's ask, you know, we have the final set of questions, guys, and I really, really appreciate, you know, Kevin, how long should someone be raising? Like how long, give our audience, if you're raising a seed, you know, that was one of the questions Janan put in there, like, are you, you know, some people are like, you're always raising. And then some people are like, no, you know, founders can't really be always raising because they have to run the business, and raising is a full-time job, according to some. What are your thoughts around that?
Yeah, well, I guess my thoughts are that if, you know, somebody once told me that the job of a CEO, the primary job, is to ensure the company never runs out of money, which means that, you know, if you're going down like the venture path, right? If you're running the kind of business where, you know, venture investors are going to be interested in what you do, you're always going to have to allocate like a double-digit percentage of your time to building those relationships and setting the stage for all of your investor rounds. You're going to be running every 2 years or so. It's never going to stop. So, yeah, I don't think that it ever makes sense to just stop outreach or relationship building when it comes to working with investors. If you're serious about building a business that's going to require outside financing, the unfortunate truth is you're always going to be doing it.
You made me laugh, you know, because I have to say to you on the Slack channel, you know, I just remember maybe about 6 months back or 8 months back, you know, I said to the team, what do you think is my number one job? And, you know, everybody on the team had all of these other things. I said, my number one job is to make payroll, right?
Exactly.
I said, right.
Exactly
I said, that's my number one job. I said, that's after that, everything else comes after that, right? And
no, it's right. Any founder that's ever had to sweat making payroll knows how excruciating that is, right?
Yeah. And that's the constant thing. And that looks at your runway, that looks at your, you know, that's constantly looking at your runway, looking at your burn, because you know, that's kind of the North flag. Okay, I appreciate that. What about how do you, you know, and I want to ask this question in a down market, because, you know, people have to be strategic also about how they're raising. So how do you position an investment when your core business, we often hear founders pivot all the time, but how do you position an investment when your core business is failing and to go back to your original investors to give you more money on a pivot? How do you do that, Stephen?
It's still the same. And again, I'm always a contrarian. I'm not a big fan of pivot, because pivot to me means you turn around and don't know where you're going.
Mhm.
I tack. I'm like a plane or a sail ship. I'm always looking at what's the outcome for the exit. We just may have to adjust how we get there. So if I have to go back and I'm like, hey, we're moving the business model here, but our goal is still this. So it's still talking about what the goal and the destination, so the investor knows you have a clear plan, even if you're changing the way you get there. So I'm a proponent of, I'm always tacking along to try to get to the destination, but the outcome is the same. How can we provide a good exit and outcome? And so it comes down to the story and just getting them to believe that you can execute even if the markets have changed.
Kevin, your feel on that?
Yeah, I'll take a different approach here. I don't necessarily have a lot of problem with founders that pivot. I mean, I did it when I was running my last company twice before we finally landed on the strategy that we needed to land on. Particularly in the early stages, investors aren't necessarily backing a strategy; they're backing the founders, right? I mean, I think that most angels and venture investors will tell you that they place just as much, if not more, weight on their belief in the team, their integrity, how well they work together, what the track record is, than the strategy, right? If you're working with with an all-star team of founders and you really believe in what they're doing and you hold them in high regard, if they come to you and say, hey, like as the investor, and say, hey, look, what we're doing isn't working. We need to pivot in this direction, and we've got all this data to back it up. I mean, that's a very convincing story, in my opinion.
Okay, Sharina, are you there?
I'm here. Can you hear me?
Yes, we can.
Oh my
So,
goodness.
Sharina, let's go. Share your absolute, we're ending on this one. Share your absolute best investment story or worst one, and the 3 lessons you learned that's an absolute takeaway for all of us here.
Well, you didn't hear my answer to one of the questions about the lower valuation. So it's going to coincide with this. The 2 other speakers spoke about the down rounds, but I do want to leave with the entrepreneurs and founders that there are some cases where you can have a very strategic investor, especially if they're at a world stage and world leading investment firm, most, like they're leaders, they're leading a hospitality firm or leading private equity firm, that you can give, discounts to, and that them being a partner with you, just takes you at a different level, as to access of other partners, access to vendors. So in that case, you can actually take, slight discount in valuation. And also you can allocate your time to vest with, spending the time building those relationships. It's like your example, Sally, where you spend 2 years building relationship in a certain geography. So I think that's very, very important, know in your mind ahead of time, I'm going to spend this number of years with this firm or this organization, and it actually comes through, it actually manifests, and it happens, so I think that's very, very powerful that it's as if you want to succeed in a field and that you choose a mentor. It's like, so I think even when you're fundraising, you should choose and think of a partner or firm that will add so much other value to your business, access to other funders, etc. Put it out there and spend the time and invest with them, even if it's, it's a case that you have to take a possible discount. Let me see if I can answer the other part. The 3 lessons learned that everyone can take away from this. One of my hardest lessons is, and in fact, I get a lot of compliment on this, and that's why they don't want me to move from fundraising, is tenacity. So I mean, all fundraisers can tell you there's so many times that they were very challenging. You had to reframe, you had to take a no and consider it as new opportunity, So I think you have to put in, it's almost like 80% is mindset in fundraising. So you just have to reframe everything, like if someone says something about you, don't take it personally, or you or the opportunity, don't take it personally, know that this is a winner anyways. So that one of my main lesson is just reframe. Ignore the noises, stay on target, like almost put blinkers on. So you don't pay attention to the noise. That's really, really important because, and then the second thing is how you spend your time. I became very, very discretionary about my time, even with my family. Sally knows our background. It's very family oriented. She knows my background as well. And the Caribbean, I am from the Caribbean, and the culture of, spending time with family and friends. I had to be discerning about that because when I moved to the US, I had to ramp up my knowledge at a VP level in a new field, a new institutional investors. So the second lesson is it can be hard on family and friends, but you have to be very discerning with your time. And that's the other interpretation of no. So no can mean new opportunity, but no can also mean saying no to things and families and friends and times and what have you. The third thing is, always be happy you have fun. I mean, if you're stressed, don't do it. Really, or do something else to make sure that it is fun. You don't want to spend your life not enjoying what you're doing. So that's my last.
But hold on, I have to be honest here. Most founders will tell you the part they hate the worst about running a startup is fundraising. So, Kevin,
I know. So can you imagine? No, but
they're like, that's not why I started my startup.
No, it's true, Sally, because over the last 2.5 years, these are the lessons learned. Because when I joined this firm, it was 200 AUM. Now it's 875 AUM, 2.5 years within a pandemic, and it's real estate. And the firm is, 10 years old. We started the first private equity fund in 2017. So it was harsh lessons in the last 2.5 years. It was tenacity. And I had to regroup over the December because I practically had no holiday, no quality holiday because the phones were always on. But I had to say, no, I need a holiday in December 2022. And I just had to unplug and detox. And it's important to take care of yourself. You just posted a picture about, you need to take care of yourself, you to take care of others. And that's important for fundraisers too.
Wow, I love that. I love that message. Okay, Stephen, let's hear, and then we'll end with Kevin. Let's hear your absolute best or worst and 3 lessons you have taken away for our startup founders. Because Stephen, I'm sure on this journey, you have had many no's and many yeses. So let's share the ones that we don't talk about.
So this is one of my favorite. I have a quote. The universe gives you exactly what you ask for if you work for it. But the universe has a weird sense of humor. And I use that as my first IPO, my first public company. So when I was 24, I learned goal setting. And one of my goals was by the time I was 33, I wanted to have a company worth $1 billion. And I won't go into why, like what we would do, but my goal was a company worth $1 billion. I started a company in 96, took it public in 99. The day I turned 33, the company was worth $987 million. And people are like, oh, that's so close. You made it. No, that's the reason I do bullseye targets now. I miss my target and I'll go through it very quickly. The company, which is what I asked the universe for, 987, so $1 billion. Number one, I only owned 8% of the public company. That was a miss. Number two, I was locked up for 12 months in a 144, means I couldn't sell my stock, miss. 3, the market collapsed in 2000. And 4, I was on a leak out where I could only sell 11% of my stock per year. What's the point of the story? Be very, very, very specific when you're building a company. What exactly do you want? Who exactly do you want to work with? Who's the person you want in your company? Who's the VC? Like the lessons I've learned is you need to be very specific, not about what you do, but about what you need, and what you need are the people that can help you make it happen.
Okay. And I will add very quickly to Stephen's quote, and then I'll give it to Kevin to wrap us up is, I always say, very often we attract who we are and not what we want. Right. And I say this very often to my team. I'm like, you know what, you attract who you are. I said, so if things are not going really well, something's going on with you. You're attracting who you are, not who you want. And Kevin, on that note, why don't you wrap this up for for everyone? Absolute best and worst investment story and 3 lessons learned.
Sure. I'm actually going to follow up on what Stephen just said. And I think the worst investment story I've heard is one that I didn't experience firsthand, but I got to watch it from the sidelines. Very close friend of mine was running a company that is now, he's now the CFO, and they've been quite successful, but the company almost failed because they brought in the wrong investor in their first round. They committed the same sin that so many other founding teams do, which is that they looked at the size of the check and the speed with which it would be written, and they didn't look closely enough at who was writing it. And yeah, when times got tough between financing rounds, this investor did everything they could to litigate, to blow the company up, to basically just swoop in like a vulture and pick up the pieces instead of working collaboratively with the team. It took my friends at least 3 years, and he probably put on, I don't know, 20 or 30 pounds of stress weight dealing with this. And luckily he's since recovered. But yeah, I can't stress enough how important it is to take a really close look at who you're taking money from, because the relationship will never be as collegial as it was the day before you wrote that check. So just give that some thought. Yeah, my best investment story is the flip side of that. I think it's the company that I ran. I was fortunate enough to bring an angel investor in who had a material positive impact on taking my company to the next level. I built a company in the media space about 8 years ago, and this gentleman went above and beyond to make sure that he got the word out about what we were doing. Made a lot of great connections for us. Just hunkered down and helped us solve problems, on his own time when we needed him. And I think that was, again, that just speaks to the overall lesson here, is really get to know your investors before you bring them inside the tent.
Well, on that note, I will say, and I will say this, Kevin, it's an absolute privilege. So I can share with everyone here, the fund Kevin is a part of is on my cap table. And I do have to say to you, yeah, it's always an absolute privilege, and you are correct. That would be my advice to startup founders. You want the people on your cap table in the early stages that, for many startups and for any business, and excuse my language, but the shit is going to hit the fan at some point, and you want at that table the right people with you who will help you solve and fix that and come up with solutions. So on that note, I want to thank all of you for being here. Kevin, I can't wait I didn't know you were here in the region, so hopefully I get to meet you sometime soon. And an absolute privilege to have all of you here. And on that note, we will say good night to all of you. How are we all feeling? Let's say hello to everyone in our community. There we go. Okay, great. Thank you, guys. That's a wrap. Absolute privilege. The music as I send you guys off. Good night.
Thanks, everybody. Cheers.
Good morning.
Bye now.
Good morning for me. And Kevin, probably.